So welcome to our discussion for hotel and restaurant accounting. Today we're going to be discussing Chapter 7. What is the title of Chapter 7? Ramandeep?
Yeah, Professor.
What is the title of Chapter 7?
Statement of income, depreciations, and amortization.
Right. So statement of income, depreciation, and amortization. So these are the most common documents that we will need in the finance department. So, can you read the definition of income statement, Raman?
The income statement. The income statement is the most popular and most analyzed statement of the three major financial statements. It reports on the operating results of a company, showing whether the company had a profit or loss from its operations, and thereby providing critical information for the company's investors and creditors.
Right. So, when we open a business, we have several objectives. So, we have the financial objective or the economic benefit. So, we want to earn money, we want to earn revenue and income. So, we also want to help the community, right? And also, we want to help society. So, in business, if we're running a business, we are also focused on its revenue and income. So we're going to also be discussing income statement accounts and then the rest later. So I'm going to share the other screen. Okay, so here we have Chapter 7. Okay, new share. So the next discussion is revenue and classification of expense. What is a revenue, Royal?
Revenue is a classification that is composed of the sales account.
Right. So revenue, obviously, it comes from sales, right? In the hotel, we have several income centers or sales centers, including guest room sales or sleeping room sales. We also have function room sales. So whenever they rent out our function rooms, we can also earn revenue from that. Plus, if we are running a food and beverage outlet or operation, we can also get income from food and beverage outlets. Other income streams could be if you have a shop or a kiosk in the hotel, or if you have a flower shop, a gym, and other concessionaires. So these are your revenue streams. Now, what about expenses? How do we classify expenses? Raman?
Expense is a classification that represents the day-to-day expenses of operating a business, such as wages and utilize expired costs such as depreciation and the right of prepaid expenses and the consumption of inventory items. If inventory held for resale is consumed, the expense is called cost of sales. If supplies inventory is consumed, the uses is charged to a supplies expense account.
Thank you, Raman. So here we need to classify what kind of expense we are using an item for. So expenses are your day-to-day cost or expenses in running the business. So what are these? It can be the salary that you pay your workers. It can be the bills that you pay your utilities. So phone company, internet company, rental of the place, is also part of the utility. Now, this word, Raman, is depreciation. Depreciation. Depreciation means that some of the items experience wear and tear as you use it or as the years pass by. So, for example, you buy a brand new car. So, a brand new car today will not be brand new car next month, next year. So, the amount or the price will be lower. So that is the depreciation cost. So if you bought it for 10,000, if the depreciation cost is say 5%, so it's not going to cost 10,000, it's going to cost maybe 9,500. So that is the depreciation cost. Now let's talk about point of sale. So we hear this a lot, point of sale. So we have the cashier who will be recording all the transaction, or maybe even a self-checkout kiosk. So these are your point of sale system. Royal, can you read this part, please? When do we record a sale?
A sale is recorded only after the goods had been delivered and all the services performed.
Okay, so for example, if you go to a restaurant and you order food, after you consume the food or the beverage, then you pay for your meal. So that is when a sale is recorded. So after you have delivered or after you have performed the service, then you're going to record that sale for the goods or the services that you have delivered. Now, Raman, can you tell me the difference between sales and cost of sales?
And the account sales represent the retail amount of goods or services billed to guests. For example, food sales are a result of menu prices and room sales are a result of room rates. Cost of sales represent the cost of merchandise held for resale that was used in a selling process. Cost of sales does not contain expenses for supplies, labor, and other operating expenses. For example, cost of food sales in the cost of food used in servicing guests. Food used for employee meals is excluded from cost of sales.
Right. Thank you, Raman. So you have two different types of account. So you have your sales account and cost of sales account. Now, typically in a hotel or a restaurant, you have food sales or room sales. So the food sales and the room sales, it includes labor, it includes utilities. So it includes everything that went into the production and delivery of the item. Now, if you are serving staff meal, so staff meal, normally the staff will not pay for it because it's part of their benefit. So this is a cost to your company. You're not really earning money from it, but since it is a cost, then you have to record it as part of your cost of sale. So selling food to your guests is different from serving food to your staff, because for your staff is part of their benefits. Now, there are different types of inventory system. We have a perpetual and a periodic system. So there are major differences between this inventory system. So first of all, inventory is the items that you keep in stock in running your business. So let's say inventory of your cutlery, your chinaware, your food items, your beverage items. So this would be items that you have in stock in the operation and delivery of your goods and services. Now, you can use either the perpetual system or the periodic inventory system. Now, for the periodic, for the inventory cards, you use it for the perpetual but not for periodic. Now, in storeroom, you as you purchase it, you record it as an inventory if you're using perpetual. But if you're using the periodic system, you will record it as purchases. Now, for direct purchases, you will put it under cost of sale if you're using the perpetual system, but you will record it under purchases if you're using periodic. Now, are there any issues information available? Yes, if you're using perpetual, but not for periodic. Do you record it in the general ledger? Yes, but here for perpetual, you put it under cost of sales account. And if you're using periodic, no account is available. Here in the perpetual system, an inventory amount will be available, but not for periodic. And then for physical or estimate of inventory required at the end of the month, you will need it if you're using the periodic inventory system. So we know now the difference between periodic and perpetual, but what are the advantages and disadvantages? Royal, can you read the advantages, please, and disadvantages?
Perpetual system provides instant inventory status and internal control. However, it is costly to maintain. The periodic system is simple and inexpensive. However, inventory status is not known until a physical count is taken.
Right. So if you're running a business, what system do I use? Do I use perpetual or periodic? Now, for most businesses, especially bigger businesses, they use the periodic system because it's simpler and it's easier to do because you don't need to do inventory every day, right? So you can do an audit or an inventory, let's say at the end of the month, every quarter, every 6 months, or every year. With perpetual system, you need to do inventory and control every time you use it. So it's very costly. So this can be done if it's a small business, so you know exactly how many items you have left. But for a bigger type of business that's complicated and you have many other departments, so most businesses, restaurants, hotels would use the periodic system. So there's a period. So it could be monthly, quarterly, semi-annually, and annually. So how do we treat accounting processes for this? Ramandeep, can you read number 7, please?
So how do accounting treatments of storeroom purchase and direct purchase differ under the two types of inventory systems? In a perpetual system, storeroom purchases are recorded in a bookkeeping account called food inventory. In the periodic system, they are recorded in food purchases. In a perpetual system, direct purchases are recorded in cost of sales. In a periodic system, they are recorded in food purchases.
Right. So just like in this table, so you see the difference between perpetual and periodic and how it is going to be recorded. So here in storeroom purchases, perpetual under inventory, periodic under purchases. Now, item 8, there are 3 basic requirements for certain assets so that they are capitalized and then expensed. What are these requirements? Royal?
The three basic requirements are the following. 1. The property must be owned. Property purchased with a loan is considered owned. 2. The property must be used in a business or income producing activity. 3. The property must have a useful life of more than 1 year, long lived.
Right. So how do you consider property as commercial or residential, or if it's personal or business? So here, it must be owned by the business owner, or even if it's on mortgage or loan, it's still considered as owned. Now, it has to be used in a business setting. So you can either open an office or a restaurant or an Airbnb. So it's an income producing business. And of course, the property must have at least 1 year lifespan. So this is when you can consider certain assets capitalized and then expensed. So talking about depreciation, depreciation is the wear and tear or the lowering of value of certain assets. So what are the major asset groups? Raman, can you read number 9, please?
The six major asset groups are building, machinery, vehicle, furniture, office equipment, and computers.
Right. So let's say we're running a restaurant. So the building where we have the restaurant is our major asset. What are the machinery in running a restaurant? It could be a coffee maker, it could be the stove, it could be the oven, it could be the freezer, it could be the refrigerator. Now, vehicles that are used in business, so for delivery of your food, or if you are using it for transacting your business, so this can be owned by the company. So this is also considered as an asset of the company. So how do you know if a vehicle is for personal use or for company use? So you have to put the name of the vehicle under the business owner or under the name of the partnership or under the name of the corporation. Then you know that the vehicle is an asset of the company. Now, what about furniture? Furniture examples would be your chairs, tables, your bar top, your lounge area. So these are your furniture. So office equipment, everything that you use in running the office. It can be your point of sale system. It can be your modem. It can be your router. It can be your pens, papers, office supplies. And then, of course, you have your computer system. So let's differentiate the different types of terminology that we will use in Chapter 7. Royal, what is an asset cost?
Asset cost is the sum of an asset purchase price plus freight, installation, and other expenses in getting the asset ready for use.
Right. Okay, I'll ask Raman to read depreciation.
Depreciation is a method of allocating the cost of tangible long-lived assets except land over their estimated useful lives.
Right. So most items that we use for business will depreciate or will lower in value as you use it, except for land. Land normally appreciates in value. So the land that you bought today will not be the same amount when you think about 5 years or 10 years from now, especially in Canada. Land actually increases in value. So in most of your assets, so here you have buildings, machinery, this will all depreciate or will lower in value as you use it over time. But with land, as the years pass by, it will actually appreciate in value. So speaking about depreciation, what is depreciation expense, Royal?
Depreciation expense is an income statement account showing the depreciation calculation for only the current reporting period.
Right. So let's say, for example, your company vehicle. So if you bought it brand new for, let's say, 20,000. So as you use it next year, it will depreciate by, say, 5%, 2%. So you're going to put the value not 20,000, but maybe 19,000 or 19,500 because it's not the same value anymore. Now, Raman, what is accumulated depreciation?
Accumulated depreciation is a balance sheet account showing the depreciation amount for all periods. It is subtracted from the assets cost to show book value of the assets in relationship to market value.
Yes. So market value is when you sell an item. So let's say you want to sell your vehicle. You want to upgrade to a bigger vehicle. So market value is different from accumulated depreciation. So sometimes it can be higher or lower depending on market value at the moment of sale, right? So depreciation will be determined by your accountant. So if a building, of course, the older it is, the more wear and tear you have. So maybe the paint is not the same, the roofing system might be changed. So it has experienced depreciation in value. So speaking about value, we have what you call a book value. So a book value is the result of the cost of the asset minus, or you have to lessen its accumulated depreciation. So like for example, again, if you bought a car or a vehicle at 10,000 and then the depreciation is say 10%. So 10% of 1,000 is 10,000 is 1,000. So the book value then would be 9,000. Okay, so let's continue with our discussion of chapter 7. So a while ago, we talked about revenue. So this would be coming from the sales and also other interest incomes if we run a corporation that gives dividends. So the largest account in the revenue classification is sale. So in a hotel, it would be a sleeping room sale or guest room sale. If it's a restaurant, then it's food and beverage sale. So this is representing the amounts billed to your customers for the sale of goods and services. So we have sales accounting, and then you have sales taxes. Let's talk about sales taxes. Raman, can you please read this?
Sales taxes. The sale account does not include amounts charged for sale taxes because these amounts represent a liability rather than revenue. A hospitality business must account for taxes collected from guests and remit these collections to the taxing authority.
Right. So especially here in Canada, when you buy an item, sometimes it doesn't include the taxes. It is added at the end of the bill, right? So let's say the price tag says it's 16.99. So 16.99 is excluding the GST and HST. So they're going to add it at the end. So the sales tax we need to pay the government for the sales of the goods or the services. Now let's talk about tips. Royal, can you read this slide, please?
Any tips entered on credit card draft are excluded from revenue because these amounts belong to employees, not the hospitality company. To facilitate accounting for these tips, Hospitality firms often pay the tips to employees at the end of each shift, then wait for collection from the credit card company.
Right. So, especially here in Canada, there is a tipping culture, right? So, at the end of any transaction, if you go to a restaurant or a hotel or a salon that gives service, you will be prompted if you want to give 15%, 20%, 25% tip, or you can choose an amount. Now, these are charge tips. So when you say charge tips, it is going to be added to their credit card bill. But since normally there is a period before you can collect from the credit card company, so how are you going to pay for the tips? Because the tips doesn't belong to the company, it belongs to your staff, right? So I had a student before who owned a salon. So she operates a hair salon. And then I asked her, how do you give the tips to your staff if it's charged in the credit card? So she said, to make it simple, I will just add all the tips at the end of the service, and then I'll give it to them as cash. So let's say for ramen, you earned $55 tip. So at the end of your shift, I'm going to give you $55. So this is your tip for the day. Let's say Royal, how much did you earn for your charge tip for your shift? So let's say she also earned $55. So you will get it from your own account and then give the tip to your staff. Also, at the end of the month during the credit card billing, then you will add this to your account. So this is only applicable if you're running a small company. But if you're running a big company, there are different policies and procedures in giving out tips. Like in my case, when I was working in the hotel, we get our monthly charge tips. So we get it at the end of the month, not every day, not every week. With cash tips, so cash tips are put in the tip box. It is divided equally at the end of the week. So it's weekly tips for cash and monthly tips for charge tips. So expenses, we have discussed it. So these are the things that we pay for the operation of the business. So it can be salary, wages, utilities, and bills. We've also discussed cost of sales. So an example would be employee meal. Employee meal is an expense because your employees will not pay for their meals because this is part of their benefits. Now, how do we calculate for gross profit? Royal, can you read the slide, please?
The profit on raw materials is called gross profit and is calculated as follows: sales minus cost of sales equals gross profit.
Right. So your sale is not equal to your profit. You have to lessen or minus the cost of sales before you can get your gross profit. And gross profit is different from net profit because from your profit, you have to also lessen or minus the taxes, and then you will get your gross profit. It's similar to gross income and net income. So when you earn, like for ramen, when you earn your salary, do you get your salary every week or every 2 weeks?
Every 2 week, Professor.
Every 2 weeks, right? So you will see from your pay slip your gross income at the end of 2 weeks, but they will deduct your taxes. So you will get your net income every 2 weeks. And taxes in Canada would range from 20% to 30% depending on your income. If you are a minimum income earner, normally it's about 20 to 25%. So if you're earning, let's say 500 per every 2 weeks. So 20% of 500 is how much? 550 is 10, so 100. So you should expect that for every 500 of your income, the government would take 100 from your income. This would go to taxes. So it's a lot, but it goes to the services that we get for free, like health services, roads and bridges, and other services needed by the people. So we've talked about periodic and perpetual inventory systems, and we have differentiated the two. So we'll skip that. Let's talk about inventories. Royal, please read this slide.
In the hospitality industry, many items are requisitioned and stored temporarily in the bar or the kitchen. Measuring inventory of bar stock is required so that inventory records are accurate. Full and open bottles of liquor, wine, and beer in kegs and other beverage inventories must be physically counted. Large hotels and restaurants inventory food items in the kitchen area at the end of each month. Small operations may not do so because the effort expended is likely to exceed the intended benefits, or when the results are not expected to have any material effect on net income.
Right. So inventory is physically counting how much item you still have. So let's say you want to do an inventory of your bar. You have to count how many bottles of wine do we have? Red, white wine, champagne, sparkling wine, beer, soda, everything. So it can be quite complicated and it can be lengthy, right? So in big companies, normally they do monthly inventory or quarterly inventory. But if you're running a small business, it's up to you when you need to do inventory. Normally, they do at least quarterly. So if you have staff members who can do the physical counting of your inventory, then that would be better control of your business. So there are other operating expenses that we need to consider. Raman, what are these operating expenses?
The day-to-day expenses incurred by a business during its operational activities are referred to as operating expenses. They include payroll taxes, employee meals, supplies, kitchen fuel.
All right, so meaning you still need to pay your staff, your workers, even if you don't have a lot of guests or you have more guests. So let's say you have 10 staff members regular, but during lean season, you only have 2 or 3 turnovers. So you're not making a lot of business. So here, you still need to account for your operating expenses because these are day-to-day expenses. So even if you're busy or not busy, you have to account for your operating expenses. What about fixed expenses, Royal?
Certain expenses are not an active part of operations, but are incurred regardless of the level of business. Even when the business is closed, they are 1. Rent, 2. Property tax, 3. Property insurance, 4. Interest, 5. Depreciation, and 6. Amortization.
Thank you, Royal. Okay, so going back to operating expenses, you can lessen or increase your operating expenses depending on your business situation. So if you need more people, if you are doing an event or catering, then you have to pay more for your operating expenses. So let's say for a particular event, you have to hire 20 servers. So for your employee meals, you need to prepare 20 employee meals for your servers. If it's a less busy time, so then you don't hire a lot of servers, maybe you have 10 employees, then your operating expenses would also be lower. So it's not fixed, it is variable. With fixed expenses, so it doesn't matter if you're busy or not busy, you still need to pay for it constantly. So your rent will not increase or decrease every month. So it's fixed. So if you have to pay 5,000 every month, whether you're busy or not, you have 10 employees or 5 employees, you still need to pay for your rent. You still need to pay for your taxes. So all these are considered fixed expenses. So two things that's not unavoidable in life is paying taxes and also death. Hopefully, we don't meet death anytime soon, but taxes are expected, right? So what are income taxes expense? Raman?
Income taxes expense. Income taxes are levied by the federal and state governments on the income of a corporation. It is possible for a corporation to pay income taxes even if it had a loss for the year. This is because some states require the income tax payments to be the largest amount resulting from a specified minimum payment, a tax computed on a corporate equity at a tax computed on a taxable income.
Right. So it depends on your situation, whether you don't have income or less income, or if your expenses exceed your income. So normally in Canada, there are brackets. So if your income is at this level, then your percentage for income is also at this percentage. So for example, when I first came to Canada in 2019, I only worked for 3 months. And then at the end of the income tax period, I did not have to pay for any taxes. Now, the following year, I was working more and more regularly. So I paid income taxes. But since my expenses exceeded my income, I had a refund. So I had a tax refund, which is great because I got money back from the taxes I paid. So similarly, in businesses, you have to submit your income taxes for the operation of your business. And then you will know if you have a tax refund or you owe the government more taxes. So we've talked about depreciation. So this would be a lowering of the value of assets, but you have to consider its useful life cycle. So let's say, for example, a dishwasher. How many years can you use a dishwasher for? So let's say you can use it for 20 years. If you pay for a dishwasher that is worth 1,000, so if you calculate it 1,000 divided by 20, so that would be the cost of your dishwasher per year, right? But of course, a new dishwasher is different from a used dishwasher or an old dishwasher. So every year it's going to depreciate in value or it's going to lower its value. So here is an example. Let's say you bought a car or a vehicle and it's 12,000. So you're going to estimate the useful life. Let's say you're going to use it for 3 years. So each year, it will decrease by 4,000. So an expense should be increased by 4,000 for each year over a 3-year period, right? So 4 times 3 is 12,000. So in the income statement, it would show the allocation of cost for the specified period in the account called depreciation. And this is the depreciation expense, and you have to set it at 0 at the end of each year. So these are some of the terminology that we have defined a while ago. So I'm not going to repeat it anymore. By the way, Raman, if you go to your student portal, so I have uploaded the slides. I also included a reviewer, right, Raman? So if you click this, it would show the different terms. So let me share. So this is the document that you will see. So for each of the chapter, you will see the different accounting terminology and the definition. So if you go to chapter 6, okay, that chapter 7, 5. Oh, we're doing chapter 7. Okay. So for chapter 7, here are your terminology and your definition. Okay, so it would help you in answering your quizzes and your midterm exam.
Okay, Professor.
Okay, so let's continue with chapter 7. Okay, share my screen. Okay, so let's talk about amortization. Royal, what is amortization?
In accounting terminology, amortization is the process that allocates the cost of an intangible long-lived asset over its useful life. Intangible assets include franchise rights, trademarks or trade names, patents, copyrights, and covenant not to compete agreements. The useful lives of intangible assets depend on many factors, such as utility to the owner and legal protection provided by the seller or government.
Right. So let's say you're running a franchise business, right? So the franchise is normally executed because you want to run a business that is already a well-known or established brand. So let's say you don't want to open your own restaurant from scratch. So what you do is you buy a franchise, let's say a Subway sandwich restaurant. So here, the intangible asset from a franchise would be the rights to operate the business, the trademark. So the trademark is the logo and the design. So patents, copyrights is also part of your franchise agreement. So what are the procedures? Raman, can you read? This is the last slide.
For integral assist, there is a no allowance for amortization account. Instead, the cost of the integral assist is directly reduced to reflect its an amortized cost basis.
So here are some intangible assets. So you have IRS is similar to the CRS or the CRA, the Canada Revenue Account. And then you have your Financial Accounting Standards Board. So they have different principles with regards to the intangible assets. With the IRS, they allow income deduction for goodwill. But for financial accounting standards, they don't allow that. So you need to consult with your accountant. What are your deductibles? What are some of the assets that you can deduct from your income? So it would lower your taxes.